Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is February the 13th, 2024. It is now 1:31 p.m. Central Time. We have received the report of the Consumer Price Index that came out here today for the readings of what happened in January. So how was inflation in January? Let's take a look and see how markets are reacting to this report that came out. Unfortunately, hotter than expected. So as the CPI came in a little bit higher than what expectations were, home loan interest rates are not liking that. So let's take a look and see. Now, we talked about this yesterday, that we were hoping that we would see the year over year consumer price index headline reading at 3.0 or better. It came in just a touch over that at 3.1, as you can see here. Now, look at the article title here. Prices rose more than expected in January as inflation won't go away. Okay, so you see how they make this look here. They want to make sure that it sounds terrible. Prices rose by more than expected in January as inflation just won't go away. Let's look a little further into that. So consumer price index increased by 0.3 in January. We were hoping that it was going to be a little bit lower on that headline reading, but on a 12-month basis, that came out at 3.1%, down from 3.4%. So inflation is subsiding from 3.4 year over year to 3.1 year over year. Shelter prices accounted for much of the rise, climbing 0.6 on the month, attributing to more than 2/3 of the headline increase. Okay, so understand, shelter accounted for 2/3 of the increase. So shelter was just this major outlier that was going up while most everything was going down. This makes sense. Shelter is going to be very difficult for us even in the long run. Why? Because we don't have enough inventory to cover all of the households that are being created. We just don't. We're not going to. We are way short on housing inventory while household formation is going up. Let's also talk about, what about the 10 or 12 million people that have come into the country in the last few years? Where are they going to live? Those people need housing as well. So all of a sudden you have even more demand, and yet there isn't really any large increase in inventory. That is going to create a frenzy of buying, which makes house prices go up, shelter costs increase, whether you're talking about, hotels, motels, rents, or actual home purchases. They're going to continue to go up because we have so much demand right now. All right, now what do you think is going to happen when interest rates go down? Let's say interest rates drop this weekend or this week down to 5%. Do you think we'd have some more demand than we have right now? Of course we would. Tremendous demand. Would we have any more houses to sell? Maybe some, if some people decide to sell and move somewhere else, they see an opportunity, but we're not seeing massive amounts of homes being built. So we're going to have a very difficult time with our inventory as household formations continue to grow. So that is a big component of CPI. And they're stating in that article that was something that really kept that number afloat to higher than what we were hoping to see. So let's take a little bit further look at this here. This is a great article. I'll make sure to put a link in the email. But it shows month over month appreciation according to the CPI. Here is January at 0.3. And again, we talked yesterday about the fact that we were replacing January of 2023, and that was 0.5. So again, we went from 0.5 to 0.3. That is good news for inflation, showing that inflation is coming down. Look at some of these numbers back in 2022. Huge appreciation month over month, right? Let's scroll a little bit further down. You want to talk about, is inflation coming down? Well, look at right here. In June of 2022, headline consumer price index was at 9%, guys. 9%. And here we are at 3.1. So is inflation subsiding? Yes, it is. The whole upset today is that they wanted to see it subsiding faster, but it is subsiding. It even did subside as of the report today. Here's the core reading right here, which is less food and energy. So if we take the headline reading, we minus food and energy, make the same calculations. And at one point, it was at 6.6%, and it is down to 3.9. This moves a little bit more slowly because it does not have the volatility of food and energy, which is why people pay attention to the core reading. Let's go a little bit further down. The last thing I wanted to show you before we jump over to how the markets are reacting, this paragraph right here. Used vehicle prices declined. Apparel costs fell. Medical commodities declined. Electricity costs rose in December, January. Well, this was January. I would think so. Airline fares increased 1.4. Also, probably reporting from some of the holiday travel. The grocery store ham fell 3.1 and eggs jumped 3.4. The reason I'm pointing that out is because it shows a little bit of the fact that the consumer price index, when I say it's a basket of goods, it is extremely diverse. It is everything. I mean, there's thousands of items that are in that report that get tracked every month to see if things are going up or down, and then kind of give us an overall reading through the consumer price index as to whether the general cost of living in the United States is increasing, falling, or staying the same. And again, a healthy economy has an increase, according to the economists. A healthy economy will have inflation of about 2% year over year. Right now, we're showing the headline reading for consumer price index is at 3.1, down from 9.0. I'm okay with that. But let's take a look and see what the markets think about it. Right now, mortgage-backed securities, alert to lock. And that is the last thing we want to see, guys. Alert to lock. We are down 57 basis points on the 6.0% coupon. The 10-year treasury is up 14 basis points. Look at our charts over here. Here's our drop for the day. Broke below the 200-day moving average. We are currently at 100.17, and the 200-day moving average is 100.25. So we are right now below the 200-day moving average. We do not want to close today below the 200-day moving average. We really hope that this is a knee-jerk reaction to the report. It's going to get digested, and we'll see some gains and come back from that. We do not want to close below the 200-day moving average, because otherwise we'll wake up tomorrow and have the 200-day moving average as a ceiling of resistance rather than a floor of support. And we all know the 200-day moving average is a very, very tough customer to work with. Let's see how home loan interest rates are reacting to that. Jump into the Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan that we look at, pretty much every single day, the exact same scenario. We were at 6.875% with a pretty healthy credit as of yesterday. After the report that we have today, we are showing 6.999 with about that same amount of credit. So in general, what happened to home loan interest rates today after a difficult, disappointing, not much, but enough to rally the markets, that's for sure, upset the markets? We had a 0.1% difference from what was expected, and we saw 55 or 59% loss in mortgage-backed securities, but that equated to only 0.1% in home loan interest rates as of today. We'll have to see how the day continues, but that's where we are right now. Let's take a quick look here at the parameters for the scenario that I just put up on the screen. They are right there. And what if we were to open this up and look for some other interest rates as of today? So if you wanted that 6.875, it's going to cost $230. All right. Yesterday, it was giving us $1,000. So you can see the difference on this scenario, that it did hit the market in general by about 0.1%. Now, again, market is not closed yet for the day. It could get worse. We could have a repricing, a daily reprice or intraday reprice as the market continues to change. But we are hoping that the knee-jerk reaction will subside as they kind of look further into the report, understand that it was heavily weighted towards housing. Other things are really showing improvements. Inflation went from 3.4 to 3.1. There should be some people that are looking a little further into this and understand that it's not that bad of a report, but we have to see how the markets treat us. That is it for today. Let me know if you have any questions. Reach out if you have a client that might want to talk to us about a pre-approval and what we can do for them on their home loan interest rates, and I will talk to you again soon.